In 2011, the United States credit rating was downgraded by Standard & Poor's, S&P, from AAA, highest possible rating, to AA+. This was the first time that the U.S. had ever had its credit rating downgraded, and it sent shockwaves through the global financial system. There were a number of factors that led to the downgrade, including the country's growing debt burden, political gridlock in Washington, and concerns about the U.S. economy's ability to grow in the long term. The downgrade had a number of negative consequences for the U.S. economy. It made it more expensive for the government to borrow money, which led to higher interest rates on Treasury bonds. This, in turn, made it more expensive for businesses to borrow money, which slowed economic growth. In the United States, the Dow Jones Industrial Average, DJIA, fell by 634.76 points, or 5.5%, on the day of the downgrade. The S&P 500 index fell by 61.12 points, or 4.7%, and the Nasdaq Composite Index fell by 149.09 points, or 4.4%. The sell-off was broad-based, with all 10 sectors of the S&P 500 index closing in the red. The downgrade also had a significant impact on stock markets around the world. In Europe, the Pan-European Stoxx 600 index fell by 2.8%, and the FTSE 100 index in London fell by 2.5%. In Asia, the Nikkei 225 index in Tokyo fell by 2.4%, and the Hang Seng index in Hong Kong fell by 2.2%. The downgrade of the U.S. credit rating was a major event that had a significant impact on the global economy. The sell-off in the stock market was a sign of investor concern about the future of the U.S. economy and the global economy. The downgrade also led to a flight to safety, with investors buying U.S. Treasury bonds and other safe assets. The downgrade of the U.S. credit rating was a wake-up call for the U.S. government and for investors around the world. It showed that the U.S. economy was not as strong as it seemed, and that the government's ability to manage its debt was not as strong as it had been. The downgrade also showed that the global economy was still vulnerable to shocks, and that investors were still worried about the future. The downgrade also had a negative impact on the stock market. Investors became more risk-averse, and stock prices fell sharply. This led to a loss of confidence in the U.S. economy, and it made it more difficult for businesses to raise capital. The downgrade also had a negative impact on the global economy. The U.S. is the world's largest economy, and its credit rating is seen as a benchmark for other countries. When the U.S. credit rating was downgraded, it led to concerns about the stability of the global financial system. Conclusion, asterisk. The U.S. credit rating downgrade was a major event that had a significant impact on the U.S. economy and the global economy. The downgrade made it more expensive for the government to borrow money, which led to higher interest rates and slower economic growth. The downgrade also had a negative impact on the stock market and global financial markets. The U.S. credit rating is still at AA+, but it is possible that it could be downgraded again in the future. If the U.S. government continues to accumulate debt and the political gridlock in Washington continues, it could lead to another downgrade. A downgrade would have even more negative consequences for the U.S. economy and the global economy. Call to action, asterisk. The U.S. credit rating is a vital indicator of the country's financial health. A downgrade can have a significant impact on the economy and the stock market. It is important to be aware of the factors that could lead to a downgrade and to take steps to protect yourself from the negative consequences.